Good afternoon, and thanks for joining us for our Ag Outlook webinar. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me this afternoon is my colleague and Associate Director of the Center for Commercial Agriculture, Dr. Michael Langemeier. We're going to review several things today for you, but we're going to start off by presenting some information from our Ag Economy Barometer. As most of you know, we survey 400 farmers nationwide each month to get their opinions about what's going on their farm and also the U.S. ag economy. And one of the things we do is allow them at the end of the survey to just tell us what's on their mind. And we use that to generate some word clouds. So I'm going to show you a word cloud generated from the January 2019 survey, and then we'll show you one from the most recent survey here in November. And before I do that, I guess I forgot, I wanted to promote our Purdue Top Farmer Conference that's coming up here in early January. That'll be January 10th at the Beck Agricultural Center here in West Lafayette. We also have a pre-conference focused on risk management the afternoon of January 9th. So if you're interested, tap into that by going to purdue.ag/topfarmer20. All right, so here's the word cloud from January of 2019, Michael, and you know, I think if you wanted to summarize it in one word, it'd be trade, right?
Definitely.
There were some other considerations there. Prices was actually a function of what was going on in the trade arena. People were thinking about some other things, but it was really focused on trade. When we surveyed people in the middle of November, the picture looked a little bit different. Trade was still important, but basically, I think people are concerned about everything.
Yes, regulation's a lot bigger, politics is a lot bigger, China's a lot bigger, prices is probably similar to what it was in January, but yeah, there's a lot more things on people's mind than in January 2019.
And I think that kind of way summarizes the risk that people are thinking about as they prepare for 2020 and think about what's going on their farm. And a year ago, it was all about trade, and I think we all kind of thought, a lot of people thought that if we resolve the trade situation with China, then things would go back to normal. But I think now people are a little more concerned and maybe a little more cognizant that there's really just a little bit more than just trade out there to worry about or think about. All right, so let's take a look at farm income. USDA has published an updated forecast for 2019 here just before Thanksgiving. And on the chart, we've put up U.S. net farm income deflated, expressed in 2019 dollars to make everything comparable, going back to 2000. And of course, the all-time peak was in 2013. Income dropped pretty sharply into 2016. And then we've rebounded significantly since 2016. And USDA's most recent estimate for 2019 is $92.5 billion. That's about $4 billion higher than their previous forecast. And if you think of it in percentage terms, that's almost a 50% increase compared to where we were in 2016. So it's been a pretty significant rebound in net farm income from a national perspective. But I suppose the part that maybe some of us are a little bit concerned about is the percentage of that that's coming out of direct government program payments. And in inflation-adjusted terms, government payments up about 61% in 2019 versus 2018. And a part of that is obviously the MFP program payments, I think, carried over from 18 into 19. But nevertheless, a big boost, a large percentage of net farm income coming out of those farm program payments. And truthfully, without the increase, we wouldn't be looking at an increase in net farm income this year.
You know, certainly not. And 19 would be down compared to 18 without this very large increase in government payments.
So that's really made the picture for 2019 look much, much better than it would have without that. And of course, that's even with the downturn in yields, et cetera, that we've been facing this year.
But before we leave this chart, it does open the question, what is 2020 going to look like from a government payment standpoint? Obviously, that's going to be very important to 2020 net farm income.
And you're right, and that's the question you and I both get when we're out doing meetings around the state and around the Midwest. That question comes up pretty often. USDA is going to have to make a decision here probably in early January as to whether or not to make that third tranche of the 2019 MFP program payments. And then there's a question about whether or not there might be an MFP program for the 2020 crop, which is going to hinge on what takes place with respect to the trade agreement with China. My personal perspective is that the third tranche is pretty likely, but it depends on what happens here with the trade picture. So we'll have to find out in early January. On a couple of previous surveys on the Ag Economy Barometer, we've asked producers whether or not they think it's likely that they would receive an MFP program payment for the 2020 crop. And the two times we asked that question, I think it came back at about 60%.
Yeah, it was it was over 50%, that's for sure.
Well, I think 1 month it was 58 and the other was 62. So about 60% of the farmers expect to see an MFP program payment on the 2020 crop in the absence of a trade agreement, I guess. So you've done some work looking at financial stress, and that's been a question we also get a lot about with respect to phone calls and other questions coming up. So you've taken a look at that in a detailed way, and I'm going to let you explain exactly what you did.
Yeah, the primary reason we update this periodically, but the primary reason we've been updating this recently is we're getting a lot of questions: is what does financial stress look like compared to historical? And usually when people ask that question, they're looking at that period between 2007 and 2013. And of course, that was a period of very good net returns. And so we wanted to look at this in a little longer perspective to include the 80s farm crisis in there. Also, the early 2000s was not particularly good for some farms. There were some low prices during some of those years. And so we wanted to compare today to those two periods, 80s farm crisis and the early 2000s. This chart summarizes that information. Let me back up here a little bit. There's two components to financial stress. One is negative net profit margin, which essentially means that your net farm income was not big enough to cover operator and family labor. So that would get you a negative profit margin, and also high debt. Now, certainly, when you look at the net farm income minus operator and family labor, that's been pretty tight for a lot of people. And so we're not showing that chart here, but over 50%. Of the people are having negative profit margin, or close to that anyway, and so that's been pretty high in recent years. What's keeping the financial stress down below compared to some of the other periods on this chart is the fact that the high debt to asset ratio, the second component to financial stress, the percentage of farms with a high debt to asset ratio over 0.7 hasn't increased all that much. And that goes back to thinking about what are the major components of the U.S. farm balance sheet. Well, by far and away the largest asset is land. Land comprises 83% of all assets in U.S. agriculture. If you look at the U.S. balance sheet put together by USDA ERS, land prices have declined recently. We're going to talk more about land prices later in this webinar, but they haven't declined near as much as what you think they might have, given the fact that net returns are lower. So let me be more specific here. From about 2007 to 2014 in Indiana, for example, land prices more than doubled. They've come down since then about 15 to 20%. And so the key point here is land prices are still significantly higher than what they were prior to 2007, and that's really kept the financial stress to much lower levels than what it would have been otherwise. And so we are seeing some tick up in financial stress the last 3 or 4 years, but we're still relatively low compared to where we've been historically.
So it kind of helps put things in a little bit of perspective. We're not saying that the farm income situation out there is great. It certainly isn't when you look at any of the data sources that we've been looking at. But when you compare it to some of the periods of time when we have had some severe stress, we aren't anywhere close to that magnitude.
Yes.
So let's look at it another way. On our most recent survey, we asked operators, do they expect the size of their farm's operating loan in 2020 to be larger, smaller, or about the same as it was in 2019? And as you can see at the chart, no big surprise, roughly 2/3, 64%, said their operating loan would be about the same as last year. 17% said smaller, but 19% said it would be larger, or expected to be larger anyway, in 2020.
Before we move on to talking more about the larger, I was a little bit surprised, Jim, that the smaller was 17%. We have to remind viewers who were sampling in the Ag Economy Barometer, these are full-time farms. And so I was a little surprised to see the percentage that said smaller was 17%.
It could also tie back to another question that we ask on the barometer, I think once a year, which is, what do you plan to do in the next 5 years?
Yes.
And the percentage of people on that survey that have been telling us pretty consistently that they either are going to retire within the next 5 years or don't plan to grow has been about roughly 50% on the February 2019 survey. So
Yeah.
I think that's reflective of that group that's either
Yeah, I think so.
moving towards retirement perhaps, or at least thinking about retiring. So we asked a follow-up question with respect to the group that said they expected to have a larger loan. So this next question only went to that 19% that said a larger loan was expected in 2020. And 30% of them said it was because they were going to carry over unpaid operating debt from 2019 into 2020. Well, if you work through the numbers in our survey, that means about 6% of our sample expects to carry over unpaid operating debt. And Michael, thinking back to the last slide that you had, based on the Kansas Farm Management Association
The financial
data,
stress is right around 5%.
yeah, so those two are really pretty close. And I think depending on, we've asked this question a couple of different times, depending on the data source and the time, it looks to us like somewhere between about 5% and maybe about 7 or 8% of the farms in the U.S. are suffering a pretty significant degree of financial stress. And if you look at the historical periods, that's still well below the historical periods that are typically referred to as eras of significant financial stress. So that kind of helps put that in perspective. All right, let's turn our attention and talk a little bit more about what's taking place with respect to the crop outlook. This is the yield chart, national average yields from USDA for the corn in the U.S. If you look at the numbers, 2019 we averaged 167. That's down significantly from a year earlier when we were averaging 176. But you have to say those are surprisingly good yields. As we think about what the yield expectations were when this crop was getting planted back in June, and even spilling over into a little bit of maybe early July in a few cases, I don't think too many of us thought we were going to see 167. I certainly didn't. I thought that was unlikely. The trade thought it was unlikely, and yet as harvest has unfolded here this fall, the story we've been hearing, especially here in the central Corn Belt and eastern Corn Belt, yields were better than expected based on what people thought was taking place in July and perhaps August as well. So despite the fact that we had surprisingly good yields, they were still lower than last year and we had smaller acreage. That combination did pull down the size of the corn crop. Interestingly, this is the third year in a row that we've reduced the size of the corn crop. And if you think of it, going back to 2016 when we set the record at 15.1 billion bushels, we're down about 1.5 billion bushels over the last, going back to 2016. So that's a pretty significant decline in corn production. Still a large number, but it's starting to make a dent, starting to make an impact. One of the challenges, though, the corn industry has been facing has been the fact that ethanol usage has plateaued. And again, I guess putting some historical perspective in here, this chart starts in 2005, which was the year the Renewable Fuels Act was put in place or passed by Congress. And if you look at the chart, you can see how much ethanol usage has changed over time in terms of the percentage of the crop going to ethanol versus the percentage of the crop going to feed and what USDA characterizes as residual usage, which is kind of a leftover component. So in 2005, 14% going to ethanol, 55% going to feed. If you look at recent years, they've been pretty balanced at about 38, 39% going to each of those two categories. And that's been a challenge for the industry because we had that really good time in the industry when we had that surge in demand coming from the ethanol sector. It took a while for the industry to catch up from a supply side perspective, but now that we've caught up, we're kind of looking for that new source of demand, and that's really been the challenge for the industry here in recent years.
And as I do meetings, you probably get asked the same question. What's the next demand shock? Short term, I don't think there is one.
Right. I mean, I think if in terms of seeing some growth in ethanol, it would be a widespread movement to E15.
And then the feed and residual use. I mean, we're about 40% there, but I don't see that getting much higher than that as a percentage.
No, not as a percentage, but on the ethanol side, it would be a movement to E15.
Yeah.
And longer term, it is about growth in livestock production, right?
Yes, and certainly longer term, we can talk a little bit about that, I think. Longer term, we are, the growth in population in the world and more importantly, the growth in per capita income would be positive towards a feed and residual use.
Right, from a long-term perspective. So I mentioned acreage earlier, and I think, that we had just short of 90 million acres this year, so really actually pretty flat with the prior year, and that was a surprise. I mean, there was a big debate over the course of the summer, but that was a bit of a surprise given the weather conditions we had. But the question, Michael, going forward is, what's going to happen in 2020? I think everybody's expecting a rebound in acreage, but the magnitude of the rebound is...
That's certainly an open question. And let's talk a little bit about 19 before we go any further here and look at some of the soybean numbers. I think one of the reasons why 19 was higher than some people thought is the signal was clear in late May and early June, plant corn. The market was encouraging people to plant corn. We've talked about that in previous webinars, and so I think to the extent people could, they kept planting corn. I've heard all the way as late as June 15th in the Eastern Corn Belt, and even a little bit later than that. And so, and that turned out pretty good. Those yields turned out pretty good for people, at least surprisingly better than what they thought they were going to be. But I think there was good reasons why we did see the 19 number close to 90 million. But as you indicate, looking to 2020, it's going to depend on the relative profitability on corn and soybeans, and we're going to talk about that. But let's just throw out a number here. What do we have? 12 million prevent plant acres, Jim?
Actually, a little more than that.
A little more than that. Well, let's say this increase. Let's say we planted 5 to 6 million acres of that to corn. Yeah, where would we be compared to where we've been historically? Would that be wouldn't that be the second highest acreage ever?
Second or third, and so that would be a big number, right?
It would be a big number, I admit that.
And it would have a big impact on what the balance sheet looks like for the 2020 crop. So I think, but that's going to be the debate that takes place over the course of the winter, is what's going to happen to corn and soybean acreage? How many of those acres are going to come back into production? Obviously, most of those that were in the prevent plant are going to come back. And then the second question is going to be the relative balance. And we'll talk about that towards the end. But that's really going to be a debate that takes place all winter long. And I think, truthfully, it bears watching closely in terms of the relationship between corn and soybean prices in terms of what the market is encouraging over the course of the winter. Let's turn our attention, excuse me, a little bit at soybeans. The planted acreage plummeted on soybeans. And really, let's back up a bit. What happened there on the corn side, as you mentioned, the market was encouraging corn planting to continue in terms of the premium that was being offered for corn relative to soybeans. The other thing that was going on was the way the crop insurance program was structured. It made a lot of sense to continue to plant corn, and if you weren't able to continue all the way as far as you intended, to take prevent plant on corn as opposed to taking prevent plant on soybeans. And there definitely was a shift there with respect to acres that might have originally been thinking about soybeans. By the time we turned it in, it turned out to be acreage that was actually going to be intended for corn. So that kind of influenced what happened, but that did pull down the soybean numbers dramatically, 12.5 million acre reduction compared to 2018. So we came in at 76.7 million acres, and that gave us a big drop in production. That was the acreage reduction was compounded by yields, but again, yields were stronger than we thought they might be back in July and August. A lot of debate over the course of the summer about yields. They were down, according to the U.S., roughly 4 bushels to the acre on the national average, but you know, I think if you did a survey of a lot of analysts in July and early August, I think most of us thought it was probably going to be down more than that. So,
and we got to remember that 16, we got 16 and 18, 52 and 50.6. Those were very high yields compared to the trend. And so if you compare the 19 number to trend, it's not that much lower than the trend. Maybe a bushel or two?
Right. And I think if you look at trend for going to 2020, it's around, well, depending on how you estimate your trend, between 48 and 49 bushels per
so
acre.
We're not that much below trend in 19, which is really surprising, of course.
So you put those two together, and that gives us the production numbers. And this chart is really a surprise if you haven't seen it, right? The 3.55 billion bushel crop this year versus 4.4 a year earlier. That's a huge drop, right? Roughly 900 million bushels, down about 20% compared to what it was in 2018. So that really did tighten up the supply situation. And of course, with the loss of access to the Chinese export market, we kind of needed that, right? So it did tighten things up. But again, maybe not quite as much as we thought last summer. So this is the ending stocks as a percentage of usage for both corn and soybeans on the same chart. The green one is the soybeans, the blue is corn. You look on the corn side, modest tightening. We went from a 15% carryover to about a 14% carryover based on USDA's current estimates. The soybean side, though, we tightened up pretty dramatically. We went from 23%, which was as high as it was because we lost access to the export channel to soybeans to China. But this year at 12%. That's the good news. I think the bad news is if you look at that chart and think about the years when we've had some really strong price scenarios, you can look at them on the chart there. If on the soybean side, you think about 2011, 12, 13. Look at where the carryover was as a percentage of usage in those years versus where it is right now. So 12% is a big reduction in supplies compared to last year, but compared to the years when supplies were historically tight and we really got a significant pop in soybean prices, they're still pretty large.
And we'll talk about the relative profitability of corn and soybeans later on, but from 13 to 18 approximately, or 13 to 17 in particular, soybeans were relatively profitable compared to corn, and this chart helps explain that.
Yeah.
When you have tight supplies like that, the market wants you to plant soybeans, and that's what we saw. Going back to the previous slide, Jim, I think you've done some calculations looking at, assuming similar usage to this last year, how much production we would need for carryover to remain the same.
Yeah, so a lot of ifs there.
Yeah, I know.
There's just a lot
I'm going to put you on the spot.
There's a lot of moving parts there, so I didn't throw up a chart because of the large number of moving parts. But, you could think about, first of all, I think if you're going to think about projections for next year, this time of year, you have to start off using trendline yields.
Yeah.
Basically a normal weather kind of a scenario. And assuming that technology does give us the small annual boost that we typically expect.
Half a bushel usually.
On the soybean side, and a little more than that obviously on corn,
yeah,
closer to
two
on corn. So when you do that, you start bumping the acreage up. On the corn side, if we get any acreage numbers close to what you're looking at, we could be looking at a corn carryover as a percentage of usage significantly higher than that 14% I'm showing on the chart. On the soybean side, it doesn't look quite so negative, but it depends an awful lot on what you assume on the trade side. So we've got a little more wiggle room on the soybean side, and we could have a bump in acreage, a fairly significant one, and maybe keep that carryover not too much different than what it is today. But there's a lot of ifs on that one.
But certainly, looking at the production in 19 at 3.55 billion bushels, that's going to need to be closer to 4. Am I incorrect on that for usage not to slip?
Yeah, so if you think about it, odds would favor a soybean crop in 2020 above 4 billion bushels. Somewhere in the vicinity of 4 billion bushels to basically keep that carryover about flat. Okay. So we could increase production about 500 million bushels and probably not affect the carryover as a percentage of usage very much. But that's the wild card, right?
Yes.
So, but it does kind of give us an idea in terms of what we're a little bit worried about. We're both, I think, a little bit concerned about potentials for a pretty big rebound in supplies in 2020. And we'll talk more later about maybe evaluating pretty closely the pricing opportunities that you have today and whether or not you want to think about doing some pricing on that 2020 crop. Let's take a look at the world situation. If you look at the world supply situation, particularly on soybeans, it didn't balloon as much in 18 as what we saw in the U.S. numbers, right? And that's reflective of the fact that what happened on the U.S. numbers was loss of access to the Chinese market, and we had a dislocation. But on the world side, things didn't bump up as much. But we did see an increase to 32% last year. Again, coming down with the literally coming out of the U.S., pulling that down from 32% to 27% in 2019. The corn chart is a little more interesting in some ways because if you look at it, we peaked in 2016. That was the year of the record corn production here in the U.S. And notice we've been pulling it down every single year since then. Now, admittedly, we have been pulling down U.S. supplies at the same time, but what that really tells you is we've been, on a consistent basis, we've been consuming more corn than we're producing the last several years. So that longer-term tightening on the corn side maybe is a little more encouraging and actually gives you maybe some prospects for further improvement perhaps going forward. Let's take a look at the prices. This is USDA's national average price history as well as their forecast for the 2019-2020 crop marketing year. $3.85 on corn. I don't have the numbers up there, but if you look at those previous years, 16 and 17, I think we averaged about $3.36. In 18, we averaged about $3.61. So $3.85 is a nice improvement relative to those previous national averages, and of course, that's one of the components that's helping us out a little bit with that net farm income
Yeah,
forecast.
and we'll want to compare this chart to the soybean chart, which we'll get to here shortly. This is certainly a different trend than what we're going to see on the soybean chart.
Yeah, so let's take a look at the soybeans. Soybeans, in a way, have been pretty flat going back to 15. We've been bouncing above and below $9 since the 2015 crop year. USDA's updated forecast, which just came out a week or so ago, they did reduce it. They were at $9 for the midpoint of their pricing range. The midpoint of their range now is 15 cents lower at $8.85. However, that was before the most recent round of announcements, and you and I were talking before the program started about the rally we've seen in soybean prices here these last, roughly 3 days now. So soybean prices have rallied pretty substantially. I think if you look at nearby soybeans, I think they've gone up in the ballpark of about 60 cents recently, over roughly the last 2 weeks now, as the market has become more optimistic about striking a trade deal and seeing some improvement in exports. Corn has rallied as well, but not as much. So if USDA was issuing a forecast today, it might be higher than that 885.
Well, and the January markings are usually relatively high. People hold grain until at least January for primarily for income tax planning purposes. But and so that January price is going to make a difference on whether we see this adjust just upward.
Right. So we'll see how that shakes out. Let's take a look at excuse me, some marketing opportunities. So this is a picture of the corn basis chart coming off of our website. So we've got the crop basis tool, which covers Indiana, Illinois, Michigan, and Ohio. And I happened to do a chart here this morning for Northeast Indiana, which is Adams County. The way the basis tool works is it covers crop reporting districts, but when you actually use the tool, you pick off your state. You pick off your region by picking off the county that you live in, and then the tool kind of pushes you into the correct crop reporting district. And we do corn and soybean basis, and I'll show a soybean chart here in a minute. And then you can pick off the futures contract that you want to compute basis off of or relative to. So this particular chart is computed relative to May corn futures. And the idea was to think about potential improvements in basis that might take place over the course of the storage season. The blue line on the chart is the most recent 3-year average, and then the black line at the top is basis that's been occurring here so far in this crop marketing year. So these are all based on 1 day per week. We use Wednesday cash and futures prices to report the basis, and then update it on Friday so that you can see what's taken place that week. And you can see the basis levels have been very strong relative to historical averages. If you go back into harvest time, we were looking at basis levels in Northeast Indiana, which is a part of Indiana where we had a pretty significant amount of prevented planting acreage as well as late planted corn, so a lot, and as well as a strong demand structure from the livestock side and the ethanol side. So basis levels running about 40 cents more positive than average in that region. The gap between current basis and the average has narrowed recently. And I think what we're probably looking at is a scenario where basis improvement this year is not likely to be as much as normal. If you look at that average in Northeast Indiana, harvest time basis averaging below minus 40 in that October, early November timeframe. And then as you got out into April, we typically see basis maybe not get all the way back to even money, but less than a nickel negative basis. If you look at what's going on this year, we're going to see less than normal improvement in basis, and that implies weaker storage returns for corn than we typically have. Last year was a tremendous year for corn storage returns as the basis became more positive as we headed through not only the winter, but especially the strength in the spring. That's not likely to be repeated this year. So, and when you look at the carry in the futures market, that doesn't look very attractive as well. So going forward, unless you get very optimistic about what's taking place with respect to futures prices, corn storage returns look kind of weak. And if you're a storage hedger, isolating yourself from futures price movement, expect less than typical basis. So corn storage returns, not so good. That encourages people maybe to think about taking advantage of the rally we've seen in corn prices and perhaps doing some pricing. If you look at the soybean picture, it's actually a little bit different. Soybean basis has also been stronger than average, but notice back to harvest time, the gap wasn't as wide as what we saw on the corn side. And then maybe more importantly, as harvest wrapped up, we've continued to see soybean basis continue to strengthen. Again, this chart is for Northeast Indiana, and there are some regional differences as you start moving around the Corn Belt. So you're going to see some different patterns as you move around, but nevertheless, that continued strength in soybean basis is indicative of the potential for maybe somewhat stronger returns for storage on soybeans. And there's much greater carry in the futures market for soybeans. So if you look at it from that perspective, the combination of picking up the carry in the futures market as well as some basis improvement, storage returns for soybeans look quite a bit more attractive potentially than corn. So keep that in mind as you're thinking about making marketing decisions going forward. And then most of the people that I've talked to haven't really started doing pricing on the 2020 crop. But if you haven't been looking at it, you probably should. So we took a quick look this morning. These 2020 corn futures this morning, when I looked a couple hours ago, were about 401. I happened to do a basis forecast for Southwest Indiana, looking at the history for fall delivery, probably about minus 20 or minus 22 cents. You put that together, if you hedge today, add that negative basis in, you'd be locking in an expected sale price for a hedger of about $3.79. And then based on some work that we've done here at Purdue, along one of my colleagues, Nathan Thompson's done a lot of work on this, there'd probably be an opportunity, if you're have a storage opportunity, you could roll that hedge forward at harvest time to one of the deferred contracts to take advantage of the typical increase in futures market carry that occurs, and then also capture the improvement in basis. So that would be one strategy. The other one would be to hedge straight into the May 21 corn futures right now. Even hedging directly into the May futures, given the carry in the futures market and the change in the basis forecast, that combination starts to look pretty attractive. And Michael, I think you've looked at this pretty extensively with your budgets. If you have an opportunity with trendline yields to lock in prices above $4, that starts to look attractive,
It certainly does. I mean, on high productivity soil, the break even now is closer to the 385, and so if you can lock in something over 4, try to lock something in over 4. And moreover, think about the uncertainty with respect to what prices may end up being in the fall of 2020. I mean, you could paint a scenario where prices could be significantly lower than what you're talking about on this slide if we plant a lot of corn. And so I think that's important for people to factor in too. There's just there's quite a bit of downside risk for both corn and soybeans, depending on where those prevent plant acres end up going, whether they go to corn, soybeans, or mostly corn, mostly soybeans. And so I strongly encourage people to think about marketing part of the 2020 crop when we have these rallies.
Yeah, and the rally that's taken place in recent days, creates a nice opportunity to start pricing, and we're not advocating a high percentage of the 2020 corn crop being hedged at these prices, but if you haven't done any pricing, and I think most of the people that you and I have been talking to at meetings here the last few weeks haven't really started yet, if you haven't started, these are not unattractive prices, so take a look at it. The picture in soybeans is a little bit different. So November 2020 soybean futures, I think didn't settle. We're trading at 966 when I looked this morning. Again, doing a Southwest Indiana basis forecast of minus 40 for fall delivery. That gives you a 926 expected sale price for fall delivery. That might not be as good as you might be hoping for. And truthfully, if the trade picture with China really materializes, it might wind up being higher than that. But again, that's not maybe such a bad spot to start doing some pricing. Do you agree, Michael?
Definitely, and then just think about where we were even 3 weeks ago. This is extremely strong prices, even compared to where we were 3 weeks ago. And so again, taking advantage of some strengthening in soybean prices while you still can.
Now, there is a difference between the soybean market and the corn market. And if you look at the deferred futures into 2021 on corn, as we indicated in that last slide, there's a pretty significant positive carry in the corn futures market. That is not the case for soybeans. In fact, soybeans are inverted. When you look at the 2020 fall delivery versus the spring of 2021, we've actually got some months in 2021 priced below fall of 2020. So first of all, that does not suggest even looking at hedging directly into spring futures. And it does indicate an unusual situation in terms of what the market might be expecting to happen this next winter, right? It implies an expectation of some relatively tight supplies in the fall. When you see an inverted market situation, typically that's an argument for the market basically arguing that it wants the supplies sooner rather than later. Typically we see that in short crop years. So an interesting scenario developing there in terms of what the market might be expecting. Relative to not only production in 2020, but perhaps more importantly, what the market's expecting with respect to trade.
Yeah, definitely.
So with that, we'll kind of move on and think about some of your forecasts, Michael.
We wanted to provide some definitions to some of the upcoming slides here, just so you know what we're looking at. First of all, net farm income. This would be net farm income off an income statement, gross revenue minus cash expenses and depreciation. Typically, you exclude operator and family labor from an income statement because there's not W-2 wages for family members typically. And then opportunity costs associated with land that's owned and machinery that's owned is also not included. And so we've got a slide or two on using net farm income, and then we've got a slide looking at net return to land. This is what you want to compare to cash rent. And so we've subtracted all costs except for land, and that's directly comparable to what the market cash rent is in a particular area. And so we're going to look at a slide comparing net return to land and cash rent. And then finally, economists love to talk about economic profit. That's where the earnings come in here at the bottom. Gross revenue minus all costs, including opportunity costs. And just remember, over a long period of time, earnings is expected to be zero. If you looked at earnings, for example, for the case farm we're going to look at here shortly, and you looked at earnings from 2000 to 2018, there's ups and downs, of course, which we'll show you on a couple of these slides, but the average is zero.
Okay.
And so when you take into account all these opportunity costs, what that essentially means is the land that you own is receiving the market cash rent. The machinery that you own is receiving a rental payment corresponding to the interest rate, and so on.
And I guess maybe the final comment there, Michael, is the fact that the way you're looking at it with that opportunity cost for those assets, it's not going to match up with what somebody's checkbook or tax return or even a net farm income statement that's based on.
It's certainly not going to match up with cash, net cash income, but it's also not going to match up with net farm income.
Right. All right, so let's look at it that way. Here's the chart.
This chart's pretty busy here, so let me explain what's going on here. First of all, the net farm income is in the triangle, and so that's what the net farm income is for this case farm. And obviously, it was really strong from 2007 to 2013, particularly for 2 or 3 of those years. And then once we moved into 14, prices dropped quite a bit. Net farm income in some of those years was not terrible. You see 16 and 18, for example, it's over $50 per acre. But certainly some of those years, like 15, it was actually negative. That triangle is negative. That was a very wet year for west central Indiana, the wet June in particular, and so net farm income was relatively low because of low yields. And then all the way to 20 there, we're expecting net farm income to be close to zero, but I'll qualify that here in a little bit. We also have the checkered box, and those boxes are the government payments. Those would include Ark County PLC payments, and then before the 2014 Farm Bill, that would have been under the old Farm Bills where the payment was more a fixed amount per acre. That's why those checkered boxes 7 through 13 look almost identical. They are identical. You start the 2014 Farm Bill in 14. We got an Ark County payment in 14, 15, and 16, with the payment in 15 being relatively strong for both corn and soybeans. That's why that's a pretty big checkered box. for 15, and then 18 and 19, that reflects the market facilitation program payments. Very strong payments in both 18 and 19, and really helped the net farm income. And I'll talk about the implications of that when we talk about cash rents. I've also got the crop insurance in there in green bars in 12 and 15. There was some crop insurance indemnity payments. But let me go back to that 2020 number. That 2020 number includes our estimates of the Ark County and PLC, which are zero at this point. Where there might be some payments, but based on the prices we were talking about earlier, Jim, it looks like there probably won't be Ark County or PLC payments in 2020. But it also doesn't include the market facilitation program payment. As you were saying earlier, you expect those to occur if we're still in the trade dispute with China. So do I. But I play this very conservatively when I'm talking to audiences about this, and so I'm not including them here. But if those were even $50, we'd see a stronger net farm income than 2019.
Yeah, and I think that's really significant.
Yeah.
But that does also point out how important of a driver of net farm income those program payments have become.
And when you talk about cash rents, that's a game changer. If we don't have those payments, we're still in the trade dispute and we don't have those payments, we're looking at some weakness in cash rent, because that's a pretty low net farm income, compared to some of these other years where we saw some drops in cash rent. But if we get the payments, there probably isn't much need. There probably won't see a decline in cash rent because the earnings will be similar. The net farm income will be similar to what we've seen in 18 and 19.
I would argue, though, that if we see any weakness in cash rents, they'd be reflected not in the 2020 crop year, but rather in the 2021.
Yes, there is a lag there.
Yeah, so I think it's important to remember, because most of those cash rents for next year have already been set, or at least a high percentage of them have. All right, this is pretty interesting. You've looked at the difference in earnings per acre between corn and soybeans.
Yeah, so this is using earnings, using the earnings, so full costing, including the opportunity cost. And what this clearly shows is when we were building up corn supplies for the ethanol industry, corn was more profitable than soybeans. That's why we have those green bars from 2007 to 2012. Once we plateaued in ethanol production, and the feed was fairly flat too during that 13 to 18 time period. Soybeans became more profitable than corn, and just look at how big some of those numbers are. Like 17 and 18, over $100 per acre. So extremely advantageous towards soybeans. That's why we saw the soybean and corn acres to be very similar on the U.S. level, and actually higher in Indiana, more soybean acres than corn in 17 and 18. So that helps explain what was going on there. But my point to this slide is we're in a new environment now. Given the trade dispute, given where we're at with carryover for corn and soybeans, that you can't hardly see them. At 19 and 20, it's almost the same profitability for corn and soybeans. So a much tougher decision for people in 2020 than we've seen in recent years.
And stated another way, what it favors is the traditional 50-50 split in acreage, right?
Yeah.
Where you rotate every year, right? And we'll look at that in a little more detail. But you're right, it is a big shift. And of course, as the chart indicates, in 17 and 18, those differences were strong enough. We were seeing a significant amount of, well, I won't say continuous, but soybeans on
second-year soybeans.
Yeah.
And even in some cases in East Central Indiana, 3 years of soybeans in a row on some farms. And so, and that reflects what was going on in this chart here.
All right, so you've taken a look at the ratios and the interplay between this, and so there's a lot of numbers on this chart, so I'm going to let you talk your way through it a little bit.
Okay, before we get into the numbers that are in the table, let me explain what I'm trying to do here. I'm trying to look at relative corn and soybean yields, relative costs between corn and soybeans, and so that's all factored in here. And then we're saying if the soybean price was X, let's look at $9 here. If the soybean price was $9, what is the minimum corn price needed, or kind of a threshold corn price needed for us to grow continuous corn? And if you look at that $9 row there, it makes a lot of difference on whether you're low, average, or high productivity. you would need a corn price over 421 on low productivity soil. So that probably means that we're not going to grow continuous corn on low productivity soil unless you think price is going to be that high. On average productivity soil, you need a price over 412, but on high productivity soil, that price gets below $4, which comes closer to where prices look like they may be heading in the fall 2020. But none of these prices are particularly attractive for continuous corn, and so you go back to saying that for next year with an expectation maybe 50-50. Now, having said that, the last 4 years, it's important to talk a little bit about that. The last 4 years, Indiana's had more soybeans than corn. That's only happened 6 times since 1973, and 4 of those were the last 4 years. And
your previous chart explains that.
Yes, it certainly does. But like I said, we're in a new environment now, and now we're moving closer to that 50-50.
So that was soybeans versus continuous corn. This is soybeans versus rotation corn.
Yes.
And the picture changes when you do that.
Definitely.
Right?
When we talked about this last year, it looked like second-year soybeans looked like they had some potential. For some depending on what you thought that the soybean price was going to be. But let's again use that $9 soybean price. And here the story is different. Here it doesn't take that high a corn price in order for us to favor rotation corn. Particularly on the average to high productivity. It certainly looks like rotation corn is favored over second or third year soybeans.
Yeah, in a big way, right? That
Yes.
365 doesn't take too much imagination to assume that you're going to have a better corn price than the soybean side there.
Now what we've done is we've taken some of the information from the previous slide looking at the net farm income, and rather than using net farm income, we're going to use net return to land. And so all costs are accounted for except for land costs, and this gives us a comparison with cash rent. Now I want to talk about the cash rent line first. I've done this before in previous webinars, but I think it's important to repeat that. And if we look at 2007, we were looking at a cash rent of $150. This is for average productivity land in west central Indiana. In 2014, that was over $290, close to $300. So a doubling in 7 years. That's basically unprecedented historically, and so that kind of that's just amazing story in itself. It shows you how good the returns were for that 2007 to 2013 period. And also I want to, during that 2007 to 2013 period, the cash rent went up because the net return to land was very strong. And notice there, you typically take several years in a row of strong net return to land before you see that spike in cash rents. And so that's a very important part of the story too. Now let's start in 2014. Obviously cash rents have adjusted downward 15 to 20% depending on the quality of the soil and also the region in the state, but 15 to 20% grabs a lot of the soil productivity levels and areas in Indiana, and we can see there that we've lost 15 to 20%, but it took several years of low net return to land in a row in order for us to for cash rent to decline, and we really haven't seen much decline since 2016. So most of that occurred in 2015, 2016. 17, 18, and 19 are very similar to what we saw in 16, and so the question is why. Well, when you're negotiating cash rents, you don't just look at this year, though it is important. You look at what do I expect things to be down the road. And so what this is telling me, if you look at the 19 number, we do have a gap there between market cash rent and net return to land. People must be expecting that net return to land is going to be higher than what we're seeing in the chart here as you look to 2020, for example. And so as long as that's the case, as long as people are expecting net return to land to be at or higher in the near future, we can argue that cash rents will be stable, at least stable.
Yeah, the other thing that I think could be playing in there, Michael, and as you and I visited with a lot of people around the state, we're picking up some differences in productivity across farms. And high efficiency, high productivity farms are at a stronger competitive advantage in terms of bidding on cash rent.
Definitely.
And I think some of that difference that you're picking up there is being reflected in the fact that some farms, some high productivity operations have lower per unit cost than perhaps what we're showing in the budgets, and making those cash rents actually achievable.
10 bushel higher corn prices, for example, makes this chart look a lot.
Yeah, 10 bushel yield, you mean?
Yeah, 10 bushel higher yield, which is clearly the case, on certain farms, makes this chart look much different, and that net return to land is much closer to the market cash rent. Another thing I want to make sure I circle back on is this 18 and 19 number is heavily influenced by those government payments. If we would have, I think it's very safe to say, Jim, if we wouldn't have had those government payments, we would have looked at some declines in cash rent probably in 19 and probably in 20. Yeah. But because we do have those government payments, the cash rents are more likely to be stable.
And we've seen that with respect to people's expectations. I think we mentioned earlier that people expect, well, roughly 6 out of 10 people in our survey have indicated they expect to see payments again in the 2020 crop. It's also been reflected in, I think, some of these cash rent discussions, and we're going to show some data now that actually just came out, I think, last week from Iowa State.
And then before we start talking about land values, in our Ag Economy Barometer, we've been asking the last several months, what is your expectations for cash rent in the next 12 months? And most of the people are saying about the same, but the percentage that say lower or higher is not that much different. And so again, that supports this idea that we're probably in an environment where cash rents are going to be relatively stable.
Yeah, and I think actually the percentage of people that expect to see lower cash rents has been declining.
Yes, it has, definitely.
Right? So there's less, the way I like to think of that is less pessimism there with respect to what's going on. Well, okay, the slide we've got up now is a slide that we usually show for Indiana, but this is Iowa data, and the reason we're using the Iowa data is because they just released their farmland values survey here just a week or so ago, so it's the most current information out there. So somewhat similar to the Purdue survey, except a different time of year. And so the interesting thing was the DEES 2019 values were actually up a little bit compared to DEES of 2018. In inflation-adjusted terms, the increase was less than 1%. If you look at it in nominal dollars, it was around 2%. So depending on how you want to look at that, Michael, you could argue a small increase. You could also argue basically flat prices, right? But either way, it's significant to maybe bring the decline in farmland values perhaps to a halt.
The fact that it was an increase rather than zero or slightly negative, which it has been in the past, the past several years, you can see it's been fairly flat, particularly in the high productivity. It's been fairly flat here the last 3 or 4 years. The fact that it was a slight increase, I think, does speak volumes.
And I think that's consistent with what we're hearing elsewhere in the Corn Belt. Here in Indiana, even though we had a lot of crop production problems, the information we're picking up from auctioneers suggests steady to stronger at many of the locations that we've been hearing about. So,
and it's also consistent with our Ag Economy Barometer. We do we have a question where we ask people about land values in the next 12 months, and that's been very similar to the cash rent. A lot of people think it's going to be about the same, but the percentage that's lower and higher is similar, with perhaps less people thinking it's going to be lower.
Yeah, and particularly if you look
in recent months.
If you look at the people's expectations over the next 5 years, that's really improved.
Yeah.
That has really improved. People have become more optimistic about farmland values. So even though values are still down substantially compared to the peak in Iowa was in 2013. They're still down 24% compared to the peak. But the question mark is, have we kind of found a bottom in this farmland market? I think is the question.
And I think one of the critical things that's happened in the farmland market is as most of us were thinking that interest rates were going to increase, they actually decreased in 2019, and the Federal Reserve has signaled that there may not be any changes in 2020, and so interest rates are really fairly neutral. And so when you're looking at land values, I would expect cash rents and land values to move in similar direction and similar magnitude.
Okay, so with that, I think we're kind of wrap things up. We do have that Top Farmer Conference coming up in January. In fact, we have a session with our new faculty member, Todd Keithy, who occupies the Schrader Farmland Chair, is going to have a session talking about farmland values. The other topic we didn't cover today is people making their decisions about the Farm Bill. You and I are going to do a session at that Top Farmer Conference focused on that. So lots of good information. I'd encourage you to check out the agenda. We've got a packed agenda. I think you'll find it attractive, so check it out at purdue.ag/topfarmer20. And with that, we want to wish everybody a happy holiday season. Thanks for joining us.